With so many investment options available today, it's easy to get confused about the differences between a mutual fund, an ETF, and an index fund. From the questions I receive and the discussions I see online, it's clear there's a lot of confusion out there and misinformation. While these vehicles can be great building blocks in many portfolios, they each function differently. Unfortunately, the financial industry has really muddied the waters even further by rolling out new products that can add to the confusion and lead people to pay unnecessary fees. You might wonder why they would do this. Well, check out this chart. In 2010, 81% of all funds were actively managed, contributing to some cushy lifestyle for some fund managers. But towards the end of 2023, actively managed funds only comprised around 52% of all funds. The popularity of index funds has been consistently increasing due to their outperformance, and most people have historically associated ETFs with index investing. As you will see later, that's no longer the case. Some of what you might believe about these investments may be outdated. By the end of this video, you'll have a clear understanding of their similarities and differences, learn how to avoid common mistakes, and be able to make smarter decisions that align with your financial goals. You don't want to be gullible. It's time to take control and be informed about your investments. I'd like to take a quick moment to say I would really appreciate it if you hit the like button and maybe leave some comments and questions below. It really does help, and I do try and respond to every comment. First, it's important to understand that an index fund can either be a type of mutual fund or an ETF. An ETF just stands for an exchange-traded fund. Index funds are designed to replicate the performance of a specific financial market, like the S&P 500 or Dow Jones Industrial Average or NASDAQ Composite, indices that many people are familiar with. They can also track groups of mid or small-sized companies like the S&P Midcap 400 or Russell 2000. There are even bond index funds, like the Bloomberg U.S. Aggregate Bond Index, which follows the total bond market. Many brokerage firms like Fidelity, Schwab, and Vanguard offer their own index funds tracking these various indexes. Investing in index funds is often called passive investing because these funds operate with minimal human intervention. Neither you or a fund manager needs to research individual companies or handpick stocks based on the potential to outperform the market. This sets index funds apart from actively managed funds in a significant way. In an actively managed fund, a fund manager selects the investments with the goal of beating the market. An index fund doesn't aim to outperform the market. It simply seeks to match its performance. You might be wondering if having a professional fund manager is better. There's a lot of research on that, and you might be surprised by the answer. I hope you take the time to watch this video on the channel so you can fully understand which types of funds to avoid, how to avoid paying unnecessary fees, and how to pick funds that can deliver better returns. This is important because certain mutual funds, often suggested by advisors, were created to provide compensation for the advisors, encouraging them to put their clients into specific products. I meet with so many people invested in these types of mutual funds, and they were unaware of all the hidden upfront costs. I'll leave a link to that video in the description below. Now, both mutual funds and ETFs are popular tools that allow investors to easily diversify. With just one purchase, you can invest in a large basket of stocks or bonds. For example, buying a mutual fund or an ETF linked to the S&P 500 allows you to own a small piece of 500 different companies with just a single transaction. This makes diversification and spreading out your risk very easy. For an index fund that mirrors the performance of an S&P 500, places like Fidelity, Schwab, and Vanguard offer their own indexed mutual fund version. For example, Fidelity has a mutual fund indexed to the S&P 500, FXAIX. Vanguard has the VFIAX, and Schwab the SWPPX. Perhaps the most well-known ETF that mirrors the SP 500 is Vanguard's VOO. Other popular ETFs that mirror the SP 500 are IVV, SPY, and the SPLG. Since all of these mutual funds and ETFs are index funds, they all come with very low expense ratios, ranging from 0.015% to 0.09%. Both mutual funds and ETFs can be passively managed and just track the performance of a specific index, or they can be actively managed where the fund manager or team of managers selects investments going into the basket of investments. Historically, most ETFs have been passive investments, while most mutual funds were typically actively managed. However, this distinction has been changing a lot in recent years. For example, according to Morgan Stanley, there are over 1,250 actively managed ETFs currently trading on the U.S. markets, and that's up from just 350 in 2019. In fact, 73% of all new ETFs launched in 2023 were actively managed. One of the key differences between mutual funds and ETFs is that ETF shares are traded on stock exchanges, just like regular stocks. This allows ETFs to be traded anytime during market hours, providing more liquidity and real-time pricing. For active traders, or those interested in strategies like shorting the market, ETFs offer the same flexibility as stocks. But the ability to trade ETFs like a stock is not much of an advantage for most investors, and especially for long-term investors. Keep in mind that frequent buying and selling is generally a losing proposition for the average investor. Mutual funds are priced only at the end of each trading day, based on what's called the NAV, or net asset value. The NAV is found by taking the total value of all the fund's assets minus the liabilities and then dividing that by the total number of outstanding shares. Thus, if you invest in a mutual fund during the day, you won't know the price per share until after the market closes and the NAV is calculated. Now that we've covered that, let's take a look at some other differences between mutual funds and ETFs. If you're interested in passive index funds, you can invest in those using either an ETF or a mutual fund. Since an ETF trades throughout the day just like a stock, you'll know the current price for each share, and many online discount brokers even allow you to buy fractional shares. Thus, ETFs are very easy and convenient to purchase, even with small amounts to invest. In contrast, some mutual funds have a minimum investment requirement, which can be a bit of a challenge for some investors just getting started. For example, many Vanguard mutual funds require a minimum investment of $3,000. But Fidelity offers some mutual funds with no minimum amount required at all. When you buy shares of an ETF, you are making the transaction on the open market with another person selling their shares. When making an investment in a mutual fund, investors purchase and redeem shares directly with the company running the mutual fund. If you're holding these funds in a personal brokerage account rather than a retirement account, ETFs tend to be a little bit more tax efficient, especially compared to actively managed mutual funds. Actively managed mutual funds often involve more frequent buying and selling, leading to higher turnover rates. This buying and selling can create capital gains, which are passed on to all shareholders, even if some investors have unrealized losses on their mutual fund investment. In other words, these investors may get a tax bill even if they personally didn't sell their holdings. In contrast, a passive index mutual fund tends to have a lower turnover rate and are generally more tax efficient than actively managed mutual funds. It's rare for an index-based ETF to pay out capital gains. When it does, it usually is due to a special unforeseen circumstance. In 2023, about 4% of ETFs distributed capital gains taxes to investors relative to more than 60% of stock mutual funds. If the funds are in a retirement account, you don't really need to worry about capital gains. However, indexed mutual funds may be hit with an extra tax when other investors cash out, requiring the fund manager to sell securities to generate cash. This can create capital gains taxes that are passed on to the remaining investors. In a year where you didn't sell shares, you could still owe capital gains taxes. ETFs, on the other hand, are more tax efficient because they don't incur these types of taxes when investors cash out. ETF dividends are taxed according to how long the investors have owned the ETF fund. If an investor has held the fund for more than 60 days before the dividend was issued, the dividend is considered a qualified dividend and is taxed anywhere from 0 to 20%, depending on the investor's income tax rate. If the fund was held less than 60 days before the dividend was issued, then the dividend is taxed at the investor's ordinary income tax rate. This is similar to how mutual fund dividends are treated also. There are some ETFs that are not widely traded, and this situation could add costs for the investor due to the differences between the asking price and the bidding price. By contrast, mutual funds trade without any such bid-ask spread. For most of the popular indexed ETFs, though, this difference between the bid-ask price is incredibly low and pretty insignificant. Also, since ETFs trade on the exchanges, all common ETFs can be bought and sold at any discount broker. For example, you don't need an account at Vanguard to buy their ETFs. However, some proprietary mutual funds cannot be transferred from one broker to the other. If they do transfer in kind, you can't always continue to buy that specific mutual fund at the new broker. Thus, ETFs sometimes come with much less headaches if you ever want to move funds from one broker to the other. So, index investing is much different than active management, and I hope you check out this video so you can understand which might be better for your interest. And mutual funds and ETFs can be structured as an index fund or an actively managed fund. Both mutual funds and ETFs are quite different. Due to the increased tax efficiency, it is usually recommended to use ETFs in a personal brokerage account. Within retirement accounts, the tax advantages are not relevant. Just as long as you seek one with low expense ratios, either one works well. I hope this video has helped clear up some of the differences between index funds, ETFs, and mutual funds. Thank you for watching. Please hit the like button and leave some comments below.